Right, now I'm going to kick off this morning with the highlights before handing over to Timon, who will cover the financial results in more detail. Then I'm going to come back to run through a portfolio update before wrapping up with some concluding comments. You'll also see that I'm joined here by Peter Cole, our CIO, and Jean-Philippe Mouton, our MD of France, who will help take your questions at the end. So, I'm very pleased to be presenting yet another strong set of results, underpinned by our continued improvement in consumer and retailer confidence and our effective management of the portfolio. Earnings per share is up an impressive 13.3% over the 6-month period. Strong leasing momentum right across the portfolio has driven like-for-like rental income up 3% across the whole business, which in turn is helping us grow ERVs. And I would particularly highlight our core UK shopping centres, where we achieved 3.3% ERV growth over a rolling 12-month period. At the start of June, we relocated to our new head office at King's Cross, and you can see our retail showcase in the middle picture on the slide. And we took the opportunity to refresh our brand identity. The lower corporate headquarter costs have contributed to a further 100 basis point reduction in our cost-income ratio, down to 22.4%. In total, in this first half, we made £155 million of disposals to redirect into capital, into developments and higher returning parts of our business, such as our fast-growing premium outlets portfolio. Here, brand sales were up an impressive 12% over the period. And in our VIA portfolio, I'm pleased to report that we are already seeing positive results from the specialised management of these European outlets. We're hard at work with on-site developments and extensions, and this year we expect to complete 4 schemes, adding some 65,000 square metres of additional space. Now, underpinning these strong results is a clear focus on operational excellence structured around our product framework. Iconic design is central to our developments, and the new Victoria Gate in Leeds will be emblematic of this. Within our centres, we are successfully leveraging our powerful retailer relationships to secure leading international tenants, as well as enhancing the customer experience with more leisure and entertainment, such as the new Silverburn extension anchored by Cineworld. We're adapting to the interactive multi-channel retail environment by investing in technology with our Plus app and recognising shifting consumer habits by rolling out dedicated click and collect kiosks across half of our UK centres by the year end. Furthermore, all of this is delivered with a keen eye on our environmental impact and sustainability. All of this is driving performance through the numbers, which Timon will now detail.
Well, good morning, everybody. Nice to see you here. I've got 4 areas to cover: detail of the first half financial performance, an update on our cost management activities, some analysis of the valuation trends, and financing and hedging. But first, let's look at the headline numbers, and we think these show positive levels of growth consistent with our long-term targets. Net rental income at £159.9 million is up 8.6% on 2014 due to rents from Terrasse du Port, acquisitions and a good like-for-like increase. Adjusted PBT is up 23% on last year, driven by growth in rental income, premium outlet profits and lower financing expenses. And this translates into an earnings per share figure of 13.6, a rise of more than 13% on the first half of 2014. Our interim dividend at 9.5p is up 8%. Turning to the balance sheet, the property portfolio, including outlets, was valued at just short of £8 billion at June 2015, showing a capital return of a touch more than 3% in the half year. That drove NAV per share up to 668p a growth of 4.7% on December 14. And LTV, as you can see, has dropped a little to 33%. So next, I'd like to take a closer look at rental income. Now here I've summarised the changes in like-for-like net rental income by sector, including premium outlets shown on the right. On the left, you can see UK shopping centres generated an uplift of 1.8%, with significant contributions from centres such as Silverburn, Union Square and Westquay. Gross rents grew by 2.2%. UK retail parks posted a 3.2% improvement in NRI, with a positive impact from a variety of asset management initiatives. And French retail had a decent half year, with Cergy, Saint-Quentin and Italy being the main drivers of the 2.3% uplift. So overall, the total 2.1% increase shown in green is a little above our long-term target of 2%. And for the first time, because of its increasing scale, we've shown premium outlets like-for-like growth of 8.6%, which gives a pro forma group total of 3%. Very encouraging. Now on this page, we present the adjusted profit before tax walk, which explains year-on-year changes from last year's reported number of £85 million, shown in blue on the left. And the figures, the movements, are shown at constant exchange rates. Moving across the chart, like-for-like NRI improved profit before tax by £2.8 million, and net acquisitions and disposals increased PBT by £7.2 million. Completed developments, particularly Terrasse du Port and Monument Mile in Newcastle, boosted profits by £6.5 million. Premium outlets provided an uplift in PBT of more than £4 million. There are two drivers to the decrease in admin costs of £3.2 million year on year. These comprise a £400,000 underlying reduction and the absence of a 2.8 million one-off charge from restructuring activities we booked last year. Interest expenses reduced as a consequence of refinancing, and I'll cover that a little later. Foreign exchange reduced earnings by 1.3 million, and that resulted in a first half 2015 profit figure of £108.2 million, up 27.3% on last year's number. Now, in early 2014, we launched a range of restructuring measures designed to fund investment in growth segments of our business. We tightly controlled overhead costs while enhancing our development capabilities and digital marketing platform. 2015 has seen a continuation of our cost management activities, best illustrated by the move from Mayfair to King's Cross. These actions have resulted in significant year-on-year changes in our cost-income ratio set out in the chart. Our cost structure is segmented between corporate overheads and operational costs, which are shown in blue and grey respectively. As you can see, the cost-income ratio has steadily fallen to 22.4%. Note how corporate expenses in blue have fallen from 14.5% of gross rental income in 2012 to 11.2% in the first half of this year. We're on track to meet our 2016 target of 21%, shown in the red line, due to additional rental income from extensions and developments, combined with effective management of the cost base. Now, turning to the property valuation, we segmented the portfolio by sector. These changes in value are shown at constant currency. I'm going to review the first half movements in the first column of numbers before addressing the key drivers in the grey box. The largest segment, UK shopping centres, is up 3% over the half year. This was caused by some yield shift, plus over 1% of income growth. UK retail parks saw stable values in the first half as income gains were offset by some slight negative yield movements. In France, our investment portfolio is up 3.6% due to an average of 25 basis points of yield compression. Other UK interests increased in value by 1.2%. And developments were up 5.7% in the first 6 months, boosted by our schemes in Leeds and the Goods Yard. The final major segment, premium outlets, generated capital growth of 7.1%, driven by an excellent 4.7% growth in income. So overall, the total portfolio value had a first half capital return of 3.1% and was valued at £7.9 billion at June 2015. So moving on to NAV per share, in this walk I illustrate the movement from the value of 638p per share at December 14, shown on the left, and valuation increases in our property portfolio increased now by 21p. Our investment in premium outlets was up an equivalent of 9p a share, with notable gains at Bicester Village and La Vallée in Paris. Adjusted profit contributed 14p per share, and dividends paid out reduced NAV per share by 12p. The foreign exchange impact of a weaker euro was 2p per share, and more on hedging a little later. So overall, this takes us to an NAV per share of 668p, up 30p per share, or a solid 4.7% in the first 6 months of 2015. Shifting to the analysis of debt, our balance sheet remains very strong. And in the June 15 column, you can see that total net debt was at £2.2 billion, down from the end of 2014, primarily due to development capex and acquisitions being offset by the devaluation of the euro-based debt. Gearing and LTV are comfortable at 43% and 33% respectively, and we had substantial liquidity of £450 million, following the new £415 million credit facility which closed in April. This has an initial margin of 80 basis points and refinanced the previous facility with a margin of 150 basis points. Now that's good news, as it saves us around £2 million per annum in interest. The bottom half of the table looks at some detailed ratios, and as you know, we've been targeting a weighted average interest rate, which has now fallen by 60 basis points to 4.1% due to some of those new bond and bank deals, and we anticipate further declines in coming years. Interest cover and net debt to EBITDA ratios are noticeably better than 2014. And on the bottom row, you can see our foreign exchange exposure, which neatly takes me on to hedging activities. Now, we've continually sought to protect the level of earnings per share and NAV per share expressed in pounds from quite a lot of foreign exchange volatility. And as of today, 90% of our euro balance sheet and 72% of our euro income statement is hedged. The charts show the value of these hedges in green, which are created from our euro-denominated bonds, bank debt and swaps. The euro has devalued by over 9% versus the pound in the first half of 2015, impacting property values by almost £180 million and euro income by over £2 million. But our euro-based debt declined in value in the first half, and that cushioned a fall in asset values and rental income. So the net impact on the balance sheet is less than £20 million, and the income statement less than £1 million. So because of this consistent financing structure, we're comfortable with our euro exposure. Now, stepping back, overall we're in a very strong funding position to selectively expand the portfolio. And with that, I'll hand back to David.
Thanks, Timon. So I'm now going to give, as Timon said, more details of the performance and drivers across each of our portfolio segments. First, let's turn to our UK shopping centres. So this chart clearly shows the growing consumer confidence that we're experiencing in the UK right now. In fact, it's at levels not seen since the 1990s. As a result, consumers are spending more, and retail sales across our UK centres are up 2% in the first half of the year. And given the geographic spread and consistent high quality of our centres, they very closely reflect current underlying retail trends, acting as a real barometer. Footfall is up 1.2%, and car park usage was also positive, up 2.3%. The top half of this slide shows a selection of our key leasing deals this half. The number and quality of the brands here speaks for itself, demonstrating the good momentum in letting new space, and also how top retailers continue to show demand for units in our high-quality centres. We've now done multiple deals with the likes of Victoria's Secret and Michael Kors in the period, with each now present at 5 of our centres. Our luxury retail relationships helped to secure aspirational brands such as Sandro and Seraphine at Victoria Quarter. And we've introduced a number of firsts, including a new shop fit concept for goldsmiths called the Boutique at the Oracle. We're also moving on rents, with deals signed at an average of 16% ahead of previous passing and 2% ahead of ERV. Following on from our full-year market outperformance, UK shopping centre ERVs are now growing at over 3% per annum, of which 1.5% was delivered in the first half of 2015. Now, looking in more detail across a selection of our individual centres, it is worth pointing out that ERV growth is not completely uniform. For example, West Quay at negative 1.2% was our only centre to show a reduction in ERV. The Bullring at positive 3.2% has been a consistent strong performer, and Oracle, having recently completed a successful lease renewal cycle, is currently one of the top ERV performers, up 4.4% on an annual basis. The main positive drivers of ERV are the presence of high-profile international brand flagship stores, which drive footfall and draw further strong leasing deals, low vacancy and a destination catering and leisure offer. Factors holding ERV growth back, including lease renewal cycles and letting some new space where we compromise short-term ERV growth to secure the best tenant mix. But to be clear, these headwinds are reducing, lifting the brake on further ERV growth. As I mentioned, one of the positive drivers of ERV growth is destination catering and leisure, and Silverburn is another great example of this. The centre now offers an attractive mix of a cinema and 11 restaurants, including Carluccio's, Zizi and Five Guys. Over the last 6 months, we have seen footfall rise by 7% and dwell time rise by 14%. Most importantly, though, retailers are seeing a positive direct impact on trading right across the centre, with sales up like-for-like an impressive 5% in the first 6 months. The catering and leisure sector now accounts for 14% of Hammerson's portfolio, and we're looking to target over 15 to 20% in the next few years. And strong demand from the operator is boosting rental performance, with deals in this half done at an average of 23% ahead of ERV. Now, digital technology is, I believe, a key to our future success. It allows us to interact with customers in real time, to build loyalty and drive increased spend. It also offers the opportunity to leverage valuable customer data in our marketing initiatives, but importantly, in our leasing discussions. We've now completed the rollout of our Plus app at all of our shopping centres in the UK and France. The scale of our digital infrastructure is a key differentiator for Hammerson. We have now over 6,000 Bluetooth-enabled beacons across our centres. We've been delighted with the customer response to the launch events for the app and the number of shoppers who are registering and redeeming offers. We're currently on track to reach a target of 1.2 million registered users over the next few years, giving access to a significant level of detailed customer insight data. Now, another part of our portfolio benefiting from multi-channel trends is our retail parks. First, let me give you a brief reminder of why retail parks are so fundamental to our overall strategy. As the second largest direct owner of parks in the UK, we are well positioned to benefit from the long-term, consistent performance of this asset class, and in particular, the current occupier trends towards growing click and collect. With a number of retail and catering tenants overlapping with shopping centres, we can leverage our relationships in leasing discussions. Close to 60% of our parks space has open A1 consent, and as you can see on the right-hand side, we still have a very affordable average rent per square foot, which provides an excellent platform for further rental growth. The portfolio is efficient to run from a cost-income perspective, and we've always taken an active asset management approach. The developments of retail parks offer very attractive investment returns, as I'll set out shortly. So what are the current drivers of our retail parks performance? Well, there are three trends which I described at the full year, and they continue to play out. First, the regional macroeconomic recovery around the UK, in particular in the housing market, is contributing to the rapid expansion of traditional bulky goods retailers, in particular homeware. Tapi, a new carpet retailer, is rapidly rolling out a portfolio of new stores, 4 of which are signed to Hammerson Retail Parks. In total, we've secured close to £3 million of passing rent in this category over the last 12 months, at levels around 5% ahead of ERV. The second trend is the success of high street fashion names at retail park locations. Next has more than doubled their out-of-town space with Hammerson in the last 6 months, benefiting from the demand for click and collect and also the ability to showcase their full fashion and homeware ranges in one efficient location. The third trend is the evolution of the offering itself. Further fashion brands which are previously not located at retail parks are now taking space, attractive to the modern design which offers customers amenities such as service desks and catering, as well as presenting attractive occupancy costs. We've introduced a number of firsts, including the first fat face on a retail park in England at Elliot's Field. To leverage these favourable trends, we're growing our retail parks portfolio, particularly through extensions. We have an excellent track record on this type of scheme and are able to deliver these relatively quickly and at very attractive returns at up to 40% profit on cost. And we're currently advancing 3 major retail park extensions. As I mentioned, Elliot's Field Rugby will be a next-generation fashion park and will open this October, anchored by Debenhams and M&S, with the first Ed's Easy Diner in a retail park. Having opened the B&Q Eco-Learning store at Merthyr last year, our further 14,500 square metre extension, which includes a full new M&S anchor, will complete later this year. And at the Orchard Centre in Didcot, we've submitted planning for an additional 15,000 square metres of retail and leisure space and expect determination in the next couple of months. The yield on cost of these developments is very attractive at up to 8%. So now, turning to France, and for a moment enjoy the sunshine in Marseille. Here, the consumer environment continues to be fragile, with inconsistent retail sales growth year to date, but we are making good progress with leasing against this difficult backdrop. Retail sales were down 1.6%. However, this includes assets which we have now contracted to sell and compares favourably to the CNCC National Index, which was down 2.3%. We also expect to see a positive annualised impact from the disposals and the inclusion of Terrace du Port through the second half of this year. And we're working harder than ever to secure new lettings. The team have achieved good pricing of 5.2% ahead of previous rents and ahead of ERV despite this challenging backdrop. In 2014, we launched a major re-tenanting programme in France and delivered 51 new brands to the portfolio. In this half, there have been a further 33 units let to new retailers, with a similar number in the pipeline for the second half. And we're targeting a full refresh of some 20% of our tenant base in France over the near term. Most impressive about the 33 lettings secured in the first half of the year was the number of new international brands which we secured thanks to the results delivered from our established international leasing team. 8 new international brands have taken their first store with Hammerson, including Tiger from Denmark and Italian brand Peter Rosso. Furthermore, 5 new international brands have taken their very first store in France, including Spanish brand Tuk Tuk and Rituals from Holland. This exercise is already lifting performance, with sales up 21% at re-tenanted units. We're also recycling capital in France to raise the overall quality and performance of the portfolio. We sold 2 smaller centres, realising just under £100 million of capital, taking advantage of strong investment markets. We achieved good pricing at an average of 15% ahead of book value and 5.5% net initial yield. This capital will be reinvested into developing well-positioned, attractive new schemes, such as Jeu de Paume in Beauvais, which will open in November this year, and extensions to modernise our schemes at Nancy and Cergy. Now moving on to premium outlets. We have over £1 billion invested in fast-growing premium outlets, which is captured through value retail here on the left, which is focused on growing brand sales and adding extensions. And then the VIA Outlets Fund on the right, which has an acquisition and turnaround strategy, and I'll come on to talk about this later. In the first half of the year, brand sales increased by 12% at both value retail and VIA. As this slide shows, value retail has achieved incredible brand sales growth at an average of 17% per annum for close to 10 years now. This is driven by continued strong demand for luxury brands, as well as the growing appreciation of retailers using outlets as part of their joined-up distribution strategy. One of the most significant trends is the growth in demand from international tourists to Europe. The chart on the right shows Chinese, Russian, and Middle Eastern tourists who make up close to half of the spend in Europe. And while Russian spending, as you can see, has been impacted by recent political events, the spend from Chinese and Middle Eastern visitors, continues to grow, up 17% in the most recent survey. And Chinese tourists dedicate, on average, 40% of their travel spend to shopping alone. And if you consider that only 6% of the population of China currently hold a passport, the opportunity to further increase tourism from the Far East is huge. Now the outlets market across Europe is made up of around 200 individual outlets, and here we've set out how these are categorised. The top end, shown in green, serves international fashion and luxury brands. At the very top end of this, some, such as Bicester, are achieving sales densities of up to €30,000 per square metre. At the other end of the market, shown in grey, includes a large number of low-end discount factory outlets. The middle orange area, where VIA Outlets is building a portfolio of assets, is made up of outlets which offer mainstream fashion brands such as Polo and Hugo Boss. Sales densities in this segment are between €2,000 and €10,000 per square metre. Through actively managing and re-merchandising and extending these outlet centres, VIA Outlets will lift the quality and grow sales from the assets in its portfolio to move them up within the orange band. And as you can see, in the first half of this year, across its portfolio of 6 assets, VIA Outlets has already made excellent progress, with sales densities up 13%. Now, the growing demand for high-quality outlet space creates a great opportunity for extensions at the existing outlets. Last year, La Roca Value Retail Village in Barcelona completed a 5,800 square metre extension, growing space by a quarter. Following this extension, sales were up some 30%. A similar size extension will open at Kildare Village in Dublin in October of this year, which will increase space by over 50% and add 35 new boutiques. At Bicester Village, Value Retail's most successful village, planning permission has been granted to add a further 24% space and 33 new boutiques. And for those who may have experienced the traffic jams as you come towards Bicester, you'll be relieved to hear that the new rail station delivering passengers direct from London Marylebone will be starting its service in October of this year. At our Bataviastad outlet in Amsterdam, we're moving forward with a 5,500 square metre extension to add 45 new units, and we're due to start on site around the end of this year. Now, the last 6 months has been a busy time for our developments team, as you'll see from the progress made on site in this picture at West Quay Watermark. We continue to grow scale in France. Building on Terrace du Port last year, we will add Jeu de Paume in Beauvais later this year. The centre is 75% pre-let, with the latest brands signed up, including G-Star and Superdry. And we're on track for opening in November, and the project is expected to deliver a 6.5% yield on cost on opening. On site in Leeds at Victoria Gate, we're making excellent progress. The picture shows where the retail units will be, with the casino above, and on the left, the new John Lewis store. We've now signed with Mage and White Company, taking pre-letting to over 50%, and we're in advanced discussions with further premium aspirational retailers. Having experienced particularly strong demand from catering and leisure operators, we're now providing additional space to create 2 destination rooftop restaurants. You'll have an opportunity to see progress firsthand when we host our Capital Markets Day here in Leeds in November. In Southampton, our major catering and leisure extension at West Quay Watermark is also making excellent progress. The distinctive offering continues to attract numerous restaurant and leisure brands. And today, I'm pleased to announce Cabana, the Brazilian barbecue restaurant, has joined the likes of Byron, Jamie's and Bill's. Now, alongside these successes on site, we've made material progress with our major London schemes. In Croydon, in the first half of this year, we made the significant acquisition of a further 50% of the Whitgift Centre, allowing us to take full control of day-to-day management as we transition towards starting on site. The CPO inquiry was concluded in March, and we await the outcome in September. And as we spoke about at the full year, our plans for the new centre have been enhanced to incorporate a completely new M&S anchor store, and we continue to advance the detailed design and planning for these scheme amendments. At Brent Cross, we're pleased to receive consent for 2 of the key infrastructure approvals in the first half of the year. The final infrastructure planning consent is expected to be achieved later in the second half. The CPO process has been started, and in September, we expect to receive a confirmed date for the CPO inquiry. We're progressing the scheme design, and as you'll see from the new CGI, the interior of the centre looks fantastic, and we plan to deliver an exciting new retail destination for North London. At the Goods Yard, having reflected the consultation on the initial planning proposal, and with the support of the GLA, we submitted revised plans in June. These have introduced an additional 25,000 square metres of commercial space to serve the local tech community. The design of the office buildings has been worked up, and we've reviewed the height of the residential buildings. Here we're targeting planning determination by the end of this year. And in combination, these developments will materially add to the future income and NAV growth of our portfolio. This chart shows the passing rent from developments. Since 2013, we have delivered over £30 million of incremental rent for the group, as shown in blue, primarily from the outstanding success of Terrace du Port. Our on-site development, shown in orange, will add a similar amount again over the next 2 years. In particular, Victoria Gate and Watermark, representing an additional 7% of current passing rent. Valuation uplifts from these completed and on-site schemes has been £150 million since 2013, with an additional 70 million or thereabouts to come from on-site projects. The major London developments will generate significant incremental income, shown here in green. And based on a 6% yield on cost, these schemes will add an incremental £75 million, or 22% of current passing rent, and will be a major driver of development profit over the coming years. Furthermore, this chart does not include the additional pipeline of projects which we set out in the appendix to your presentation. So, to conclude, these strong results are a reflection of our consistent strategy focused on delivering shareholder returns. We are well positioned against an improving occupier market. We are a retail specialist with an excellent quality portfolio. Across our business, the depth of retail knowledge and expertise enables us to deliver excellence in operational management and drive performance. Our cost management has been rigorously adhered to and has helped to gear up operational returns. And the development pipeline will have a significant impact on our scale and give us the chance to meaningfully shape our portfolio to ensure we have the best positioned assets to deliver future growth. The result is a consistent earnings and dividend per share annual growth of around 7% over the last 5 years, a rate we expect to continue to deliver going forwards. With that, I will hand over for questions. I think you wait for the microphone. Mike.
From Bank of America. Just a quick one, please. Could you give us a bit more feel for the outlook for retail park ERVs and the extent to which the portfolio is over-rented, under-rented? Just looking, it's interesting, you've got sort of a minimal impact from rents in the valuation. You've had 0.3% ERV growth, but it's consistently been a very good performer in terms of like-for-like net rental income. So what are we seeing on the ground there, please?
Yeah, well, as I said, we're seeing good demand from particularly homeware retailers and fashion. That is taking rents forward. I think it's fair to say that that's not really reflected in the numbers yet, but I think that's one to watch over the next couple of years. We believe in this sector with the recovery in the economy generally, the economy in the housing market. We think there is more growth to come. And certainly the deals that we have done most recently and under negotiation, there is more retail rental tension in those deals than we've seen in the last 2 or 3 years.
Tim. JP Morgan, Cazenove. In terms of the UK retail outlook, you present a pretty positive picture. Footfall, tenant sales, ERVs, all up. In terms of buttons you can push to increase your leverage into that strong market, could you talk about acquisitions? Is any appetite on your side, given what still looks like a fairly benign outlook for interest rates and funding costs, increased appetite from lenders? Is acquisitions on the table for the UK?
Well, firstly, the way we look at it is to think about how we can invest in the portfolio, so extensions, and I set out today a number that we've either got on site or just opened. Obviously, developments, a major pipeline, well over £1.5 billion of capital over the next few years, producing attractive yields on cost compared to current investment yields. Of course, we look at the opportunities in the marketplace that come through in terms of disposals, but whilst it's something we look at, I wouldn't say it's a priority, and it's probably not worth speculating in terms of what we're currently looking at. But of course, as a retail specialist, we do look at those opportunities.
One more just on the VIA. Sales densities up strongly. Is it possible to get some commentary on how much of that is due to market improvement and strength, and how much is due to the application of the Hammerson value retail model?
Well, ask Timon to cover that.
Yeah, it's a great question. I mean, we love being in this channel, the outlet channel, because it offers growth way ahead of conventional shopping centres. I'd say of the 13% sales density increase, around about 2/3 is the market, and there's about 1/3 is what the teams have done by pushing forward remerchandising, improving the marketing, particularly to tourists and high spenders, and upgrading the food and beverage. It's only been going for a year, so I think there's more to come in this category, Tim.
Couple at the front here.
Thank you. Morning, guys. Michael Burt, Exane BNP Paribas. A couple of questions, if I may. The first is just on the UK shopping centre side. I mean, you've reported in excess of 3% ERV growth over the past 12 months. You discussed the fact that headwinds are reducing. You're dealing with some of the asset-specific issues at some of the underperformers. I mean, where could that rental growth go to? I mean, what do you think is sustainable in the UK shopping centre sector?
Well, at the turn of the year, we reported about 2.5%. I said that was going to grow towards 3%. I'm delighted, therefore, to be presenting 3.5% or 3.3% over a 12-month period. I think, what we've tried to give today is a very honest, open view on ERV growth, because, of course, it is not uniform, Michael. So you see the negative in West Key, albeit that's our only one where we showed a negative, and you see the sort of higher watermark of Oracle, although that's not the highest in the portfolio. So I think inevitably, and based on the differing lease renewal cycles, you will get slightly different acceleration rates in that ERV growth. But I see no reason above 3 is not possible going forwards based on the consumer confidence, improvement in underlying disposable incomes, and the retailer confidence that we're seeing. So I think beyond that, I wouldn't want to forecast it, but as I said, that break that we've seen over 5-6 years is definitely coming off.
Thank you. And then just a second question on the development pipeline. I think you mentioned on that slide where you showed the build-up of rental income over time that you're targeting a 6% yield on cost on some of the major London schemes. That's slightly lower than you're seeing on some of the schemes on site at the moment. I was just wondering sort of how much fat is there in that appraisal, and is that sort of your best guess, or is that a conservative assumption of where you think the yield on cost could be on the larger projects?
Well, I think, look, we're still working up design on these schemes. We're still at the stage where we're in anchor tenant discussions rather than unit shop discussions. So I think those are the right estimates today. I think going beyond that, I think would be not the right thing to say at this point. Of course, we're always targeting as higher income and profit figure as we can on these schemes. But, reflecting, that's a 200 basis point, arguably, margin over a super prime MAL that would be sold today. So if you look at the income generation in the business as a result of developing, it's quite significant. So I think that's the right approach. It's the right level of yield on cost target. But of course, we'll see if we can do better.
Morning, Remco Simon Kempen. Maybe as a follow-up on Mike's question on the potential larger development schemes, we've heard some of your peers talking about construction cost inflation in the low double-digit levels. What is the risk that yield on cost, if indeed you're seeing that kind of construction cost inflation, ends up a bit lower than what you're currently expecting?
Perhaps ask Peter to cover our developments, just to give a view on that.
Yeah, we've our projects on site. We're secured, construction contracts are signed, so they will be outturned on those contracts. There is a strong demand side in terms of construction activities, particularly in London, in terms of amount of residential development. We factored that in our appraisals, and that's what you've seen our sort of cost forecasts. They've reflected those changes the last couple of years. We're comfortable with our suppliers. They actually want to work with us, which is the first step in terms of the contractors actually want to work for a professional developer. And where there is a lot of price competition is where you've got people doing projects who don't understand construction, and the contractors actually taking pricing at risk. So they're happy to work with us. Our supply chain want to work with us. We're working with them now on the early projects on Croydon and Brent Cross to get early in those supply lines to get price certainty. And we're very conscious we want to get those costs now down. So as of today, we're budgeting for cost inflation. We think we can deliver those projects, but it remains a risk in the next couple of years as we get the projects on site.
I should say it's about smart design, and with our experience, it's working very early, thinking about design and the cost impact of that design. So at Leeds, we thought very carefully about how we bring that project forward. It means using prefabricated building works in some cases, so what looks like a brick facade is actually made off-site, doesn't involve a brickie who is asking for more and more in wages. So one can get intelligent about that, and that, again, as Peter said, the contractors respond very well to our own knowledge, knowing that what we're bringing forward makes sense and that they can build it with a profit.
So over the past half year, has your assumption on construction cost inflation changed at all, or?
We had a good review of the cost of inflation over the last 6 months, so it was in effect the numbers we talked about at the start of the year reflected our outlook.
Okay. Maybe a question for Timon. You mentioned you expect your cost of debt to come down. I'm not going to ask you how much, but is that purely a function of your 2016 bonds maturing, or do you intend to do something more than just that, and then also address some later maturities and do something bigger?
We have some credit providers in the room, Remco, so I'll be very courteous and polite to them. And they've been good enough to reduce the margins on our big credit facility, but we have small credit facilities up for refinancing in the coming years, so we may be able to see that decline. That'll be one point. You're right, there is a bond due for maturity at the end of next year with a 5.25% coupon, which is way higher than the market. And we will look for other opportunities as well. You know, the business is expanding. Credit markets are very strong. We should be able to continually reduce our cost of debt, potentially to below 4%. That's the target.
Thanks.
Very good morning, guys. Mark Mosier from SocGen. I have two questions. The first one is, I can't see anywhere your historical motto about being a key retail player in Europe. It's something you gave up on, or is it still one of your targets?
No, we've taken it as read now, Mark. No, we want to be a leader in this sector. We talk about us being a retail specialist. I think these numbers are testament to that. So no, we want to be the leading retail owner, manager, operator, developer in Europe, and I think we continue to make progress in that regard.
Okay, and concretely, what does it mean? Because when someone is asking me as a question, actually, I'm not very capable to answer to that question. What does it mean being a key retail player in Europe? It means in terms of size, in terms of, I don't know, being present on all the product from low-cost retail parks to high premium value retail. What does it mean in your mind?
I think I frankly look at it from a shareholder point of view, and if we're delivering the best shareholder returns, then we're the best.
Okay. Then on your rental income, it looks like that you've got a quarter of your rental income to be reviewed, expiring at break this year. You've got roughly 10% of reversionary potential, which is even increasing following ERV growth this first half. If I do basic math, you should be able to capture this up to 4% rental growth for your business. What is preventing you to not get all that reversionary potential, or should we expect an acceleration in your rental growth in H2?
Well, that income comes through rent review and lease renewals. We're very confident of capturing it. The only issue is timing. So those negotiations take quite a long time, typically 12 months. So don't expect them all to come through in the year that we're in question and review and lease renewal. But again, I've been asked before about the reliability of that growth. Union Square Aberdeen, 20% ERV growth. We're achieving more than that in rent reviews. Silverburn, over 10% growth in rent review. We achieved that. And I've no reason to think we won't achieve the growth that's in our figures for rent review and lease renewal over the next couple of years.
Okay, thank you.
Hemant? Mark, you pass the mic that way.
Hi, good morning. Hemant Kosak from Green Street. I just wanted to talk about the French portfolio and the performance there. It's obviously lagging the UK, and that's partly to do with the market there. But how do you feel on that performance in that context, given that you've done some refurbishments? Should that be picking up a lot more? You know, you've got Primark in there. Is that helping bring numbers up? You've sold...
I'll ask Jean-Philippe to comment on the detail. Yes, lagging from a retail sales point of view, but from the factors that really matter for you as shareholders, income growth, like-for-like income ahead of the UK at over 2%, and valuation growth ahead of the UK. So I'm not disappointed with the absolute figures at all. But Jean-Philippe, perhaps just talk about what we are doing in France to make sure that growth is as high as possible.
Yeah, sure. First of all, in terms of sales, what happened this year in the first half is we benefited from the Paramark impact in Paris Nord, but please keep in mind that Paris Nord is only owned at 25% by us, so it's discounted down. And at the same time, in Place des Halles, as you probably know, H&M left and went across the street, literally. And as Place des Halles is weighting twice as much as Paris Nord, the mechanical effect is a negative effect. If we took our portfolio at 100% in terms of sales, we would be in positive territory as well. As I mentioned in the previous presentation, we have a very clear cycle. We refurbished or renovated most of our centers a couple of years ago. That, of course, led to a loss in customers, because that causes nuisance to them. So now we are in the phase where we can do two things. First, reconquer, and we have the marketing tool, a new marketing tool, which is the app. And secondly, and probably more importantly, we are now able to attract new tenants, as shown by some of the slides. Now that the envelope is much nicer and appealing to the new retailers, we can bring them. Of course, it takes a while to totally re-tenant and get rid of the poor performers and attract newcomers. But that will ultimately, when I say ultimately, it's probably a question of a couple of years, bear its fruits. Last year we re-tenanted 54, I think, or 50, let's say 50 units. This year up to now it's 34, and we expect to do even more in the second half. So all in all, we should replace something like 20% of our tenants. And the fact that in some instances the figures, sales figures, is down, it's, I would say, a good sign. That makes that's easier for us to regain possession of the unit and re-tenant it with more appealing retailers.
Right, thank you. And are there any more sales planned in France? Are there any other centres that you feel are quite weak and are dragging the performance down?
Not at this stage. It's not secret that Bercy dragged our returns down for the last 3 years. For instance, if we didn't have Bercy this year, the increase in the net rental income would have been 4.2% and not 2.3%. So that gives you an idea. So we got rid of Bercy 2. Angers was mature. It didn't drag our performance down, but it would be neutral. And there is no, at this stage, no plan to dispose of any other asset. The average quality is very good, and they are all renovated now.
Thank you.
Hi, Chris Fremantle from Morgan Stanley. Just want to ask on the premium outlets, what the further opportunities are to grow that business. We all like it. You all like it. Seems like it's doing very good things for your growth trajectory. Should we expect more acquisitions? And secondly, what is the realistic prospect of you increasing your stake in value retail at all in a reasonably visible future?
Yeah.
So on VIA, we had a very strong start last year. As you know, we acquired 6 centres quite swiftly. Thinking back to the pyramid chart that David talked about, we're very much focusing on the orange segment in the middle, and we're selective. We want to buy the right locations, we want to buy the right centres which have an appropriate power within their catchment, particularly with tourists. So we reject a lot of acquisitions, and that's been the case the first half of the year. We do have a strong ambition to grow the portfolio to at least 10 centres, if not 15, but that's a 2 to 3 year program, and we have to accept it'll be lumpy. So the message is we will expand, but we'll do it only with the right deals at the right price. The value retail relationship has been going on since the 1990s. We have a very, very close connection with the team. They're great friends, they're great allies of ours, and we continually look for opportunities. But again, we have to take it at an appropriate pace. We can't force it. If interests come to us because of our preemption rights, we'll look at them, but again, only if it's in the shareholder interest. We're very comfortable with our arrangement. It suits them, it suits us, and as you can see from today's numbers, it drives performance.
Morning, Alan Carter, Oriel. The bulk of the reversionary potentials in the UK shopping centre portfolio. Is it easier for you, generally speaking, to capture that ERV at rent review or at lease expiry or when a tenant exercises a break option?
I would say the only difference is at lease renewal, we probably have additional conversations about restructuring. So, we've talked a lot, Alan, over the last 2 years about bigger, better stores, fewer stores, but bigger, better stores for the big retailers. So quite often what happens, you roll a discussion about a lease renewal into actually an ambition to move into a bigger store, either adjoining or a completely new store. We've done that at Bullring, where we've got lease renewals over the next couple of years with Topshop, with River Island in the last 12 months. Now that therefore makes the whole like-for-like comparison on rent suddenly becomes a little bit opaque because you're not looking at the same unit, but we are confident we deliver the same underlying growth from that deal, or we wouldn't do it. Obviously, on lease renewal, quite often you build in a rent-free discussion. Can be 3-4 months, can be longer for a very big flagship store, up to 12 months in extreme circumstances. But that again is built into our figures. Rent review, relatively straightforward. It can take time.
Yeah, just explain, sort of interpret this for me, is the fact that the figures you give for rental income against previous passing, I assume that is predominantly the rent review process, and that figure's been accelerating sharply over your last 3 accounting periods, which I presume is the rent review process at Silverburn, Union Square and West Quay to a degree. But your level of leasing against ERV, the amount by which you've beaten ERV has been falling. What I'm getting at is that if it's the rent review process that's driving the acceleration in income, then is it the lease renewals and lease expiries where you're having to accommodate more while you're beating ERV by a lot less?
No, I don't think so. I mean, remember, because the review takes a long time, when you actually crystallise it, you can be dealing with a rent ERV that might be 18 months old. So there's a sort of bigger spread, if you like. I think also, and the team will tell me, hang on, David, ERV are growing, so then trying to beat those at lease renewal, which is like a new leasing discussion, is a sort of moving target. So as we've seen over the last 18 months, when we, called out, 18 months ago we felt ERVs were going to start growing, and they did. You've got that sort of move in general rents, meaning that the ability to beat that, I think, will be at a lower rate than perhaps, at the beginning of this cycle, where for 4 or 5 years you've had no rental growth, in many cases rents falling, Alan, and therefore almost a sudden catch up or a bit of bounce back where some soft deals could be beaten quite easily. So I think it's if you think of the cycle, it's only natural you get this lower beat on the ERV.
Just one other rather pedantic question, but at the interim and certainly at the full year figures, you give by shopping centre the average rent per square metre, which in theory sounds a very useful figure for you to disclose, certainly for the shareholders. But I believe that's based on gross internal area, which is of no use at all. Is there any chance you can change that to net lettable area, which would be really useful?
Yes, we will change that in future for you, Alan.
Thank you. Any other questions? No, that looks like in the room we're wrapped up. Have we got any questions over the wire? Just if we can wait a second.
If participants would like to ask a question over the phone line today, please press the star or the asterisk key followed by the digit 1 on your telephone. Please ensure that the mute function on your telephone is switched off to allow your signal to reach our equipment. We will pause for just a moment to allow everyone on the phone line to signal. There are no questions over the phone at this time.
Okay, well, that looks like questions wrapped up. Thank you again for your time. We're around for a bit longer if you want to ask any offline questions. But enjoy the weekend. Thank you very much.